press the bell icon on the YouTube app and never miss another update.
We know one thing, that the different accounting policies that we are following when we are preparing our accounting books and its tax treatment for a very large number of items is actually different. You may be following Ind AS 16 and providing for depreciation for an item of PPE. Or we might be following Ind AS 38 and providing for amortization of an item of intangible asset. But the way it is treated in tax is altogether different, isn't it? In income tax, we follow the block of assets principle and then we are charging depreciation and amortization. So what happens is, what we are doing in accounting books for many items of assets is at odds with what is allowed in income tax. Not only that, there are such a large number of expenditure for which we are recognizing a provision. For example, I may be following Ind AS 37 and I am recognizing provision for my expenditure. But when it comes to income tax, those provisions will be disallowed. The taxation authorities are like that we will give you a deduction for the expenditure, but when it is actually incurred and not when it is provided for. So you know what happens because of all these things? The carrying amount of the assets and liabilities which you are showing in your accounting balance sheet and its tax base shall be different. Yes, I used the word tax base. So that is the very first concept that I want to discuss as far as Ind AS 12 is considered. It's there in our books. Have a look at it. By tax base, we mean the tax base of an asset or liability is the amount attributed to that asset or liability for tax purpose. Just visualize for a moment that just as we prepare an accounting balance sheet, let's say we also prepare a taxation balance sheet. If you are preparing a taxation balance sheet, then at what carrying amount will you show the asset? At what carrying amount you will show the liability? That carrying amount we can understand as the tax base. Let's see how we can calculate the tax base of an asset. Tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. If those economic benefits are not taxable, the tax base of the asset is equal to its carrying amount. So we are deciding the tax base of an asset on the basis of whether future economic benefits are taxable or not. If future economic benefits are taxable, then the tax base is the amount that will be deductible for tax in future. And if the economic benefits flowing from the asset are not taxable, then the tax base is the carrying amount of the asset in the balance sheet. What I do is I just summarize this particular point and then let's discuss further. Yes, I have summarized the point of tax base of asset as you can see on the board. Future economic benefits are taxable, that FEB, I will clarify later, it's future economic benefits. Then the amount deductible for tax in future will become the tax base. And if the future economic benefits are not taxable, then whatever carrying amount that you are showing that asset in your balance sheet, that carrying amount itself will be the tax base. So what I do is I'll just request you to write this in your notebooks. Give the heading tax base of an asset. Please write in your notebook, summarize this point. We'll say tax base of an asset, that should be your heading, and then just put this particular note over there. The situation and the tax base. You can just pause this video till you are writing this particular point and then we will discuss further. Let us see question 1 and I am sure that this concept will become more clear for us. So let's discuss question 1. They are saying for following assets determine the carrying amount and tax base and decide whether it gives rise to any temporary difference. Now what is this temporary difference? The difference between what you are showing in your accounting balance sheet and the tax base, that difference will be known as a temporary difference. What to do with this temporary difference? That's an advanced discussion which we reserve for later. Right now we will simply find out the carrying amount in our accounting balance sheet, which will not be much of a problem. We will find out what is the tax base, and then we will calculate the difference between the two, and we will call it as temporary difference. Let's see question 1. There are different items, 6 items actually given to us, and for these 6 items we are supposed to find out what is the tax base. Fine. Let's go one after the other. So question 1, what I would suggest to you is that you just go through the entire question and then later on you may write it down in your notebooks. Use this as an opportunity of understanding what the concept is all about. So we put it in this way. The item, right, then we have to get the carrying amount in balance sheet. I'm writing in short, carrying amount in balance sheet. We will work out its tax base, and the difference between the two, if any, is what we will call as the temporary difference, right? Okay. Let's go one after the other. A. Cost of machinery is 100 lakhs, accounts depreciation is 5 lakhs, and tax depreciation is 20 lakhs. There is nothing more simpler than this. So we just say over here machinery, right? That's the item that we have over here. Now just see 100 is the cost and my accounts depreciation is 5. So 95 is the carrying amount in the balance sheet. I take 100 over here. Taxation depreciation is 20. So it is 80 over here. And the difference is turning out to be 15. Right? This is the carrying amount in the balance sheet because I am deducting the accounting depreciation. Of course, machinery, its future economic benefits will be taxable. I will be utilizing this machinery for manufacturing my product, and that product I will be selling in the market. And when I sell in the market, it is giving rise to revenue. So those revenue is taxable. So in that situation, the amount deductible for tax in future becomes the tax base. I have already claimed a deduction of depreciation of 20, but I will claim the remaining cost over the remaining useful life. So the amount deductible for tax is the remaining carrying amount, which I have still not claimed as a deduction. So that turns out to be 80, and the difference between the two is the temporary difference. Yes, look at item B now. They are saying interest of rupees 10 lakhs is recognized on accrual basis in accounts, but is taxable on cash basis in tax. So we say interest, as far as the carrying amount in balance sheet is considered, it will turn out to be 10, right? They are saying 10 lakhs is recognized on accrual basis in accounts, so I say it is an accounts, it is 10, but is taxable on cash basis in tax. You have recorded it on accrual basis, but I don't have to pay tax right now. When I will actually receive in tax, then I will have to pay the tax. This interest receivable is taxable, so it will fall in the first category. Just see, future economic benefit is taxable. The interest income which I will receive in future is taxable. Then what is the tax base? The amount deductible for tax in future. 10 lakhs of interest income which I will receive is going to be taxable in my hands. I am not going to get any deduction for it. Understand, it is interest income, not interest expense. You get deductions for interest expense, not for the interest income. So the income that you are earning, you are not going to get any deduction for it. So the amount deductible for tax in future is 0. So 10 minus 0, my temporary difference will turn out to be 10. Look at C, they are saying debtors of rupees 20 lakhs. Okay, so C, I show debtors over here. I'm saying it is 20 lakhs. So debtors 20. And then they are saying related revenue has already been included in the taxable profit. I must have sold on credit basis, I must have recorded the accounting entry, debtors account debit to sales, sales gets credited to the P&L and sales gets taxed in that year itself. So when the debtors will pay money to me, at that time the debtors are not taxable. So this time it will fall in the second category, right? Debtors will fall in the second category, and the second category is future economic benefits are not taxable. So if future economic benefits are not taxable, then your tax base is the carrying amount of asset in the balance sheet. So there is no temporary difference over here. Next, D, tax-free dividend. Great. So we say here, tax-free dividend. They are saying tax-free dividend of 10 lakhs. So I showed 10 lakhs over here. That's the carrying amount. Is recognized in accounting balance sheet. It is tax-free. That means future economic benefits are not taxable. It will fall in the second category. Yes, future economic benefits are not taxable. Then the carrying amount of asset in the balance sheet is your tax base. This will be 10. This will be 0. E. Rupees 2 lakhs is advance to employees. Okay, so we say advance to employees. Advance to the employees, 2 lakhs. So I'll show 2 lakhs over here. It seems that you have given some advance to your employee. The employee will repay that amount over a period of time. When the employee is repaying the amount, there will be no future economic benefits which are taxable. Yes, on this advance, maybe I might be earning some interest, and that interest will be taxable. But when the principal amount is returned back, there is no taxation on the principal amount. And because there is no taxation on principal amount, the advance to employees is not taxable. If it is not taxable, then the carrying amount of the asset in the balance sheet, that itself becomes the tax base. And finally, in the last one, they are saying closing inventory. Okay, so if I say closing inventory, we are saying closing inventory of 5 lakhs of rupees. So I'm showing closing inventory. This inventory, of course, will be sold in future, and when you will sell it in the future, it will result into sales, and those sales will be definitely taxable. So future economic benefits are taxable. If future economic benefits are taxable, then your tax base will be amount deductible for tax in future. This closing inventory the next year will become the opening inventory, and when it will become opening inventory, it will be allowed as a deduction in our accounting books, isn't it? In our taxation books. So I will get a taxation effect for the same. So my tax base will turn out to be 5, and this will be 0. Very quickly, again, I'll just walk you through this entire question. Question 1, very quickly. Have your eyes on the board. Right, the first one I believe is very simple. 5 lakhs is the accounting depreciation, so I deducted, and 20 is the taxation depreciation, so I deducted, and that's how I get my tax base. Interest, yes. Right, you have recognized 10 lakhs on accrual basis, so I'm putting 10 lakhs in my balance sheet. And then we are supposed to find out what will be the tax base. Interest will fall in the first situation. Future economic benefits are taxable, because interest is not taxable on accrual basis, it is taxable on cash basis. So next year when I will receive it in cash, then I will have to pay tax. So that is the reason the tax base will be the amount deductible for tax in future. Interest income is not a deductible expenditure, so the amount deductible is 0, and that's the reason I put 0 over here. And then the temporary difference is 10. Then you have debtors. When debtors pay you money, that money is not taxable, so it will fall in the second category. So carrying amount is what I consider here. Tax-free dividend, future economic benefits are not taxable, so carrying amount in the balance sheet, that itself is becoming the tax base. Advance to employees, when employee will return back 2 lakhs, when they return back principal amount, there is no taxation on it, so carrying amount in the balance sheet is the tax base. And finally the last one, closing inventory. Closing inventory the next year will be allowed as a deduction as opening inventory. So the amount deductible for tax, current year I'll have to pay tax, but the next year I will claim it as a deduction. So amount deductible for tax in future is 5 itself, and hence 5 minus 5, my temporary difference, is turning out to be 0. You may pause the video now if you have not written it. Pause the video now and write this as the solution of question 1. Please do it. Once you are through with question 1, I will like you to try with question 2. Right, in question 2, 5 items are given, and for those 5 items, you have to work out the carrying amount and the tax base. Yes, in the second item, there is a small correction to be done. So you first do that small correction in that second item. Question 2, the second item. It says entity A has acquired an item of asset for rupees 1 lakh for production of certain items to be sold by the entity, and then it is printed as it is deductible. Cross out the word deductible and change it to depreciated. Right? You will say it is depreciated equally over 2 years in the books of accounts. Please make that small correction. Instead of the word deductible, cross out the word deductible and substitute that by the word depreciated. Having said this, please pause this video and solve question 2 on your own. Once you have solved question 2, then play this video. That's the time when we will discuss the answer for question 2. But first, try it on your own. Please pause the video over here. Yes, this is going to be your solution for question 2. So you can just compare your answers with what I have put on the board. And I hope that your answers are matching with what is there on the board. But yes, I will definitely discuss question 2. The first item is entity A has inventory with carrying amount of 1 lakh. So I'm writing 1 lakh over here as at the reporting date. So that's your closing inventory. This closing inventory will be allowed as a deduction in future as an opening inventory. So the amount deductible for tax in future will be this entire 1 lakh. So 1 lakh will become the tax base, right? Amount deductible for tax in future. Second, they are saying entity A has acquired an item of asset for 1 lakh. It is depreciated equally over 2 years in the books of accounts. So I will be able to charge depreciation of 50,000. So 1 lakh minus 50,000, the carrying amount will become 50,000. However, in income tax, 75,000 is deductible. So I deduct 75,000 and I get 25, right? This item of machinery which I have, or this item of asset that I have, I am using it for production. Those goods I will sell in future. And when I will sell it in future, those future economic benefits will be taxable. When future economic benefits are taxable, the tax base is amount deductible for tax in future. In current year, I have already claimed depreciation of 75,000. That means balance carrying amount of 25,000 will be allowed as a deduction of depreciation in future. So 25,000 will become my tax base. Third one, they are saying royalty receivable have a carrying amount of rupees 50,000. The related royalty revenue will be taxed on cash basis. So 50,000 I have recognized in my books on accrual basis. It is taxable. That means future economic benefits are taxable. So it will fall in the first category. If it falls in the first category, the tax base is amount deductible for tax in future. 50,000 is not an amount that will be deducted in future. 50,000 is, come on, 50,000 is the amount that will be taxable in future. So amount deductible for tax in future will become 0. And difference, of course, is the temporary difference. An entity has an investment in a listed equity shares of 5 lakhs. There is no tax on gains that arise on sale of those listed equity shares. So future economic benefits are not taxable. Carrying amount of the asset in the balance sheet is the tax base. And the last one. An entity has given a loan of 30,000 to its employees. Yes, the employees will have to pay interest on this loan. That interest will be taxable, but the principal amount of 30,000 as and when returned will not have any tax consequences. So, principal amount is not taxable. Then the carrying amount in the balance sheet is your tax base. And the carrying amount in my balance sheet is 30,000. So 30,000 minus 30,000, temporary difference is 0.
Press the bell icon on the YouTube app and never miss another update.